FedEx is reporting earnings on Thursday. This is a name that has some pretty sharp moves in the past, and we're going to talk about how I'm trading it and take some questions today on Open Interest. Hello everybody and welcome. I'm Mike Coe and welcome to Open Mic, sponsored by OptionPlay. So we have FedEx earnings coming up. Obviously we also have the FOMC rate decision, which I think we all pretty much know is unlikely to yield any short-term changes in rates, but it's going to be the commentary that matters most. We're going to get that first, and then we're going to get Federal Express earnings. But the reason I wanted to focus on Federal Express earnings is that here I think maybe we can actually talk about a trade that we could do, and one that I actually put on earlier today. So the interesting thing about FedEx is that we basically have two diametrically opposed forces going on in the stock right now. The first is that relative to the S&P and relative to its own history and relative to the Dow Jones Transports, this stock is cheap. It's actually trading, and I think we can probably just pull this up. I'm just going to pull it up on a screen here. We're going to see on my Bloomberg terminal, as soon as this loads, if it loads, that this thing is actually trading about less than 13 times earnings at the moment. Right now, 12.3 times forward earnings. So that puts it at a steep discount to the group. You can see some of the other comps that are mentioned in this list. Included in them that is going to be UPS. They're not going to be reporting though until April. What is going on here? What is going on is that this area, I think there's two things really. One of those things is that Federal Express, and now we're going to just look back on the things that they're probably going to be talking about on this earnings call, had some fairly significant just operational challenges. We had some very bad weather at the beginning of the year. That impacted, among other things, quite significantly the operations at their Memphis hub. So that would certainly be part of the circumstance. But as we take a look, and I'm actually just going to go back in time here a little bit so we can just get a better look at what's going on here. This is just sort of a consolidated financial view. This is not actually an income statement, a cash flow statement, or a balance sheet. All this is on the top is you sort of get the market capitalization for the company. We can see how revenues have been changing. And I've been asked, by the way, some people had left some comments before, so please leave comments and questions. But one of the suggestions I got was, when I put data like this on the screen, please leave it up a little bit longer so that people can actually take a look at it. Now, it's not really important to jot all of this information down. All of the information here could be distilled, if you were so inclined, by going to the Federal Express Investor Relations website page and taking a look at their financial statements. But what I would highlight is that if you just take a look at the top line, you're just going to see that year on year, we're not really looking at any revenue or sales growth. In fact, we're actually looking at year-on-year declines. And that is also true when we distill this and stop looking at an annual level and just say, okay, well, how does it look at a quarterly level? So in real notional terms, we're looking at a sequential anticipated decline. So the street right now is expecting Q3 revenues, which is what they're going to be reporting. That's for the period ending February 28th. Interestingly, they put February 28th, which means I'm suspecting that they just aren't making an adjustment for the leap year. But we're looking at year-on-year declines on the top line. So, and basically flat EPS overall. Now, it should be said that, of course, I like to also inflation adjust these types of numbers when I see them. Meaning that if I see that the top line is not growing at all, and we're looking at, call it 5% nominal GDP growth, this to me is actually indicative of significant headwinds. We can also see that their margins are just sticking about where they are. Now, the company has two big operational initiatives that they're doing to try to save money and just improve their operating efficiency. One is called Network 2.0, and the other is Drive. That's all capital letters. It's actually an acronym, and you can look that up. I'm not going to bore you with that. But Basically, they are trying to find some cost savings and improvements in efficiency, which is obviously very important for a logistics company. So if we take a look at what the options market is saying, and here we can just switch over, I think, to the OptionPlay app, because I think it's kind of the easiest place to see what I'm talking about. We can get a sense now of what the implied move is for Federal Express. Remember that the back of the napkin way to figure out what the implied move is simply to take a look at the first expiration at the money straddle. So that's the call and the put that are approximately at the prevailing stock price that expire. And for this really works mostly for those with weekly options. There's more complicated math for those stocks that don't have them. You just look to the end of the week and see what that straddle is. And that's basically the mean absolute deviation. So we're going to do that right now. I'm just going to go in here and look at this earliest expiration, which is going to be March 22nd. Stock closed at 253-ish. I think that should be accurate. So why don't we just see what and conveniently enough, we've got 252.5 as a strike. So I'm actually going to choose the at the money 252.5 calls and puts. Close enough, right? And just see what that one costs and take a peek. So here we go. Now this is not the trade recommendation. I want to be very clear. All we're doing right now is establishing what the options market thinks the implied move up and down could be. Now, if we wanted to get really nuanced about it, you can actually back out the probability of moves up and down and the magnitude of those moves up and down. But I think that this is probably good enough as a starting point. And what we can see is that straddle, give or take, costs about $16.50. $1,653 is the price that you're going to see on your screen, and that's just because each contract represents 100 shares. So we can take $16.53 a share. We can divide that by the share price if we want to, and that's an implied move of a little over 6%. Interestingly, yeah, I guess maybe it's not that surprising, but when I was trading this earlier today, actually that implied move was a little bit bigger. It was closer to 7. But we're also getting a little bit of premium sucked out, I should say, just because we just chewed up one trading day. Okay. So given what we just discussed, we have a stock that's trading cheap to the market, probably 60% of the market's turn. So if the S&P is trading around, we'll call it 23 times to be, just to use a nice round number, and this one at 12.5. So it's actually just over half the valuation on a PE basis. The Dow Jones transports, when I last checked, so I think those were valued at 17-ish. I'm just going to double check that number right now to be sure, and drop this price here. Let's see. Okay, so 17.6 times forward is the PE for the transports. And by the way, this is kind of interesting as well. It's 17, where the price for the transport index is right now is 17.6 times forward earnings. And this, I think, is very interesting. One of the reasons why growth matters so much. It's 15.5 times trailing earnings. So what does that tell you? You can use these numbers to essentially back out what earnings are, right? So the Dow Jones transport average is 15,417. That's the current level, right? So we divide that by 17.6, and what we see is that that's basically $876, give or take, forward earnings estimates. Trailing is considerably higher, right? At 15.25. So we do that math, and we get over $1,000 in earnings. So what you're really looking at is a 20%. The street's forecasting that the transports overall are probably going to have lower earnings by about 20% year on year. So just to sort of keep things in perspective, let me blow this up so that people can sort of see what's in the Dow Jones Transport Index, by the way, in case anybody's interested. There we go. So probably not that surprising. We've got some rails in here. Anybody who's been driving down the highway has almost certainly seen trucks with names like JB Hunt on it. Obviously, we've got FedEx in here. We've got UPS in here. And then, of course, we've got some airlines. That's usually the case as well. You can see that those are, the passenger airlines are weighted much less heavily. Transports are much more heavily weighted towards freight and parcel service and things like that. But you can even see that Uber is in this mix as well. Okay, so what do we do here? This is a situation where the stock is bounded on one side by the fact that it is cheap to the market, it is cheap to itself, it is cheap to the transports. That's the good news. And the bad news is that their revenues in real terms are declining. The bad news is that the headwinds that everybody sees seems to be affecting all of these names, and basically the environment for the transport companies is a very weak one. And that when we look at the entire landscape, we're forecasting lower earnings for full year 2024 than what we got for full year 2023. And this sort of brings up an important note just when we think about companies, and that is that you really can't cut your way to growth. So if you're facing economic headwinds, certainly a well-managed company is going to do better than a poorly managed one, but you really are swimming upstream when you're facing these economic headwinds. So my thinking on this was that chances are the stock is actually going to end up being confined by this. So what I decided to do was put on a calendar spread. And specifically the calendar spread I was looking to. Now there's a couple ways to do this. Very frequently I will buy options that capture not just this upcoming earnings, but the subsequent one as well. There's some logic to this. One of the things that I like to think about is that the vol crush that takes place, that's the options premium that comes out. We've talked about this before. After an event takes place, is not going to be that great for options that capture multiple events. You're going to lose some, of course, once the news comes out, but they still have to capture the volatility for all of the time between now and when those options expire, and potentially one or several other catalysts as well. So it's entirely possible, for example, that UPS earnings in April might reveal insights that the earnings that FedEx is going to report this week do not reveal. And there are many other instances between now and called July expiration, for example, including the subsequent FedEx earnings that still have to remain baked into the cake of those. I also will say that it's hard for me to, here's an interesting thing. So I'm just going to use this. I'm going to move this expiration out right in here with respect to strike selection, because I think this is important as well. Oops, what did I do here? Okay, so here I'm just using a put calendar. All right. So with respect to strike selection, first things first, you may have noticed that when I went out to July, there was no 252.5 strike. I'm just going to go back to this really quickly. I apologize for bouncing all around. But my choices were the 240s, 50s, and 60s. Those were the strikes that are available to me in July. Does it matter whether the strikes are perfectly matched? Well, actually, it doesn't matter that much. $2.50 on a $250 stock is 1% of the current stock price. So if I said, okay, well, I'm going to use the 250s rather than the 252.5s and leave these marches as the 252 and the shorter dated ones as the 252.5s, I can do that. It reduces the cost of the trade. Nothing wrong with that. It also creates a situation where the peak profits are spot on pretty much the current stock price, because that is also very close to 252.5. But let's assume that those options didn't actually exist for a moment. What could one do? What would one do? And why would one do it? So this is kind of interesting because one can use a calendar spread not just to try to take advantage of the fact that the options are going to decay more rapidly on the near end of the expiration calendar versus the long end, but we can also shade the strikes one way or the other to favor our directional perspective post-earnings. So for example, in my case, I used the 250s. And why did I use the 250s? Well, you'll notice, and this is probably a hard nuance to make out, but I'm going to point to it anyway. Over here, this vertical line indicates the current stock price. And the peak of this, you can see, is actually slightly to the left, which means that the peak profits are actually slightly down. And I can actually modify that and say, okay, well, let's say I went down even further. Let's just say I chose the, something like this. So I reduce those strikes. Notice how this payoff curve is shifting to the left. So one can use a calendar spread, just in a general sense, at the money to try to take advantage of elevated premiums. But one can also use a trade like this to take advantage of that dynamic and also express their directional point of view. Like I said, I happen to use the 250s. I think it's kind of a coin toss here, whether the stock trades higher or lower coming out of earnings, because of those dynamics I just outlined. The stock has had some very violent moves. It's supported by a cheap price. Some people, bargain hunters, are going to come in and think, oh, well, if I like it at 12.5 times earnings, if it dips down, 10, 15%, maybe I want to pick it up and get the thing at, 11 times earnings. There will be those people who are driving down the highway at 70 miles an hour, looking only in the rearview mirror and seeing what has happened in the past and say, this thing looks cheap. And meanwhile, there are going to be people who are only looking at all of the warning signs that are coming at them down the highway without realizing that at some point, presumably, hopefully, this too shall pass. So for me, I'm going to just treat this one as a pair of twos going into earnings. And in fact, I think Carter Worth actually expressed that point of view in the name last week on CNBC. He was talking about that one and also Nike, which we can get to if we want to. But that's just how I happen to be trading FedEx going into earnings this week. Trade idea there for you if anybody's interested, how I was thinking about it when I did it. So I don't know if we got any questions. We have a couple. Nice haircut. Yeah. I guess that was a little bit overdue. I know my nickname on CNBC is the Professor, and I sometimes look like the Mad Professor. But yeah, every now and again I get the time to get my hair cut. There's not that much of it on my head, so what is there gets pretty unruly, so I might as well cut it off. How do you manage? Let's see here. How do you manage call spread risk reversal on a stock you want to be long? Okay, so this is actually a really interesting one. And part of that is because if you're in a call spread risk reversal, you have taken a long perspective. I don't know if we've already talked enough about FedEx. Let's move on to something else and use it as an example. Since we've got earnings and Nike coming up, why not Nike? Actually, you know what? Nike. So, first of all, not a good-looking chart for Nike. So, I'm not sure I really like using this as an example of a stock I want to be. Let's pick another shoe company that's actually growing and growing meaningfully. So, let's look at Oen Holdings. This is the Swiss shoe company. So, interesting case here. Okay, this is also a pretty volatile stock. It's a real grower. I'm sure I had not even heard of this company, frankly. Before Christmas, I got some of their shoes as tennis shoes as a Christmas gift. My wife and kids know a lot more about what's trendy than I do. if it was up to me, probably all of my clothes would come from Costco because I have to go there anyway. And what difference does it make? But other people care more about these things, and my family doesn't like to see me sport and Kirkland everything, so I end up with other stuff. Oen shoes among it. By the way, I happen to like Nike tennis shoes too. I do play tennis, so for what it's worth. Let's use a call spread risk reversal in this one as an example. So if we just pick this last tile, it's just going to just default to a call spread to begin with. A call spread risk reversal is that trade plus a short put. So we'll do that. We'll just add a short put in this thing to help finance it. Here we go. And let's expand this payoff so we can get a better look at it. I don't know if that's the best example. Let me move this out a little bit. I'm going to go up a strike to the 35s. Here, this I think is just a little bit cleaner in terms of its illustration. Okay, so why do people trade call spread risk reversals? Call spread risk reversals are a way for people to get some exposure to the upside while mitigating their immediate downside risk. So as we can see here, you actually would, if you put this trade on, you would actually only be spending or collecting about, this is basically for even. So let's just assume that you're not paying or collecting anything at all on this trade. So what happens here? If the stock falls, closed 33.10 today, you could potentially have the stock put to you at 30 bucks. That's a 10% discount to its current closing price. Why might you have selected that? Well, we can see actually that just recently we had this big gap down. Stock fell down to around 30 bucks a share. And if you didn't have the good fortune to pick it up when it fell before it rebounded quite sharply, you might say to yourself, well, obviously there's some measure of support at this level, perhaps. And maybe I'm willing to get long the stock at that level. Now, granted, one could also argue that if it goes back to that level, that's, you know, a potential danger area as well. But I think this is a good way to think about it. So I've identified a level, wish I bought the stock, sell that put, use the proceeds to finance an upside call spread with essentially no outlay of premium. And so what happens here if you want to own the stock? Well, if the stock drops, you will own it. You're going to own it at about a 10% discount to the current stock price. And if it rallies, what will happen by expiration? Well, if you just held this all the way to expiration and the stock lands somewhere between the call strike prices, so that is between $35 and $40, you will indeed own the stock because the 35 strike call will be exercised. That's again, assuming you hold it all the way to expiration. And so you will own the stock, and you'll own it at a price of 35 bucks a share, which is okay with you because the whole idea of putting the option trade on was that you would either own it at a 10% discount, but if the stock did not fall and continue to rally, you would get to participate above 35. So that's good. That's a win. Now, if the stock goes above the $40 level, which is the strike of the call that you sold, well, you're going to end up with profits at expiration, $5 a share. Not bad, right? But because both calls are now in the money, both will be exercised. You would exercise or even auto-exercise the 35s, and the 40s, which are short, will be exercised if the stock's above that level, and you will be assigned. So those are going to offset. So the first trading day after expiration, you're going to have profited by $5 a share, but you won't actually hold the shares. So a solution, of course, would be to adjust that position if you know that's going to happen. At May expiration, you could adjust the trade accordingly and just roll it out and up or something like that Maybe you just roll the call spread side. And a reason you might do that would be because if it is trading above 40 at that point, you'll have seen profits. So you're essentially going to be playing with house money at that point. Quick point. Well, let's just take a look at Oen over here and just take a look at the company's growth rate as well. And it's multiple, just how we think about this. And we can do that on my other screen now. So this one really is a grower, I have to say. So it's not the cheapest stock in the world, but as we can see, what's that? Let's see here. Let's see here. So we can't, that's interesting. Well, you're gonna have to take my word for it, I guess. We can't pull up that screen. Oen Holdings, if you were looking at my Bloomberg screen, you would see, has been growing the top line by 60+% for 3 of the last 4 years. Now, I'll grant you that the street's expectations, and that's some pretty material growth, because 2020 they did full year sales of about $425 million. The last reported 12-month period was about $1.8 billion. That's for the period ended December 31st, 2023. So, a pretty compelling growth story there. One thing I would say, I was looking at these numbers earlier today because this, like I said, is a company I like. It seems like this is definitely a brand that a lot of people are liking, and it has a lot of opportunity here. I think it's important to just think about the size of the potential market as we think about how much the company could potentially grow. Now, it is possible that other companies can step in, including Nike, for example, and try to compete with them. But I'm not sure necessarily what's going on there. So I'm being told by producer Jay that when he sees my other screen, so that means that something must have switched around. I'm actually going to switch what screen this is all falling onto here. I don't know whether he's able to share the screen with you now or not. Okay, so it seems like we had to do a little bit of screen switching around here. Okay, so here you can actually see, this is just the progression of Oen Holdings revenues over the last several years. We can see that, last year the growth rate slowed, and it's forecasted to slow a little bit more. Full year 2025 adjusted EPS estimates of about 91 cents a share. So you could look at that number and say, okay, well, 33.10, do I think 36 times forward earnings is reasonable for this? Obviously we have to put our own growth projections into this. Look, if you have 30% growth and a 30 PE, I think that's a reasonable level, and that would be fine with me. This is maybe a little bit on the high side of that. But one of the things about finding a good company that's growing is we oftentimes can find great companies, and we can also find companies that are trading at a great price, but we rarely find great companies trading at a great price. It's sometimes great companies at a fair price is about all we can usually hope to accomplish. Okay, so let's find another one. Here. Would you close out the sell side of a call? Google 135, 150 call spread, April 12th. Well, let's take a look. Okay, just load this up here. April 12th. And it was the 135.50. Okay. April 12th, weekly 135, 150 call spread. So this thing, I'm going to assume that you probably initiated this trade very recently. Probably when the stock was trading below 135. I would, personally, with this much time to expiration, I would almost certainly adjust this. So let's just take a look at a couple things. I think I previously mentioned this actually, and that is that I usually like to think about adjusting my strikes. You know, it gets onto my radar when, you know, an option starts to get to 60 delta or more. And these 135s are well north of 60 delta now. These 135 calls are actually a 90 delta option. So a couple things you could do here. You can roll the package up, or you could roll the package up and out. And I think either of those would be a suitable answer. What might that new trade look like, although you only had this on for a short period of time? So one of the things that you do find in a situation like this is that even if it runs to 150, it's not going to be worth the full $15 that is the distance between the strikes straight away until you get actually to expiration. So one way to think about it is, okay, well, how much more are you effectively going to squeeze out here? If the stock were to stay right here, 147.70, that's where it closed. So at 147.70, this $15 spread is going to be worth how much it's in the money right now, which is $12.70. We can see that actually the market price for this thing is about $10.50. So that's $2.20 worth of theta, standstill rate of return, that you're going to collect if you stay in this trade right now. And what's interesting, of course, is that this trade is going to behave in a way that's not that dissimilar to an Alphabet or Google, however you want to say it. I still call it Google most of the time. Like a Google buy rate, right? As if you were long the stock, because that 135 call that you're long is a 90 delta option, so it's basically behaving like stock. I'm going to assume, though, that you entered into this trade because you wanted to have optionality, not because you wanted a buy rate. And therefore, I'm going to suggest that you adjust that up. You could take the 135s, up and out potentially to the first out of the money strike or thereabouts. So that would be one way to do it. Let's see here. Here's a question. Ex-dividend dates and their effect on put and call premiums. Okay, so what do we have to think about with dividends? If you own the stock, you are entitled to dividends. And if you own a call option on the stock, you are not. So our intuition would lead one to believe, and this is true in the math, that the dividends increase the value of stock and decrease the value, well, doesn't really change the value of stock. It decreases the value of a call, all else equal. What happens to a put option? Well, imagine you created a synthetic call option by simply buying the stock and buying a put. So that is synthetically equivalent to just owning a call with respect to the stock price. But remember that the call doesn't get the dividend, but the stock does. So that package of stock and put there's no arbitrage to be had here, right? So it's not like there's a free way to get the dividend. But basically, all else equal, higher dividends, lower call values. And that goes into something we sort of call, in the aggregate, the cost to carry. Ex-dividend dates are important, though, because if you have a call option that is in the money prior to the ex-dividend date, then it is possible that the value of the dividend exceeds the value of optionality on that strike at that expiration. And you can actually make that determination by comparing the net present value of the dividend that the stock would collect to the value of the corresponding put that expires on the same date, same strike. Let me see if I can actually find an example of this. Let's see if we can, this would be probably pretty interesting. And we probably need to look at a stock that has a chunky dividend relative to its stock price to get a sense of it. So why don't we take a look at AT&T? Oops. I think AT&T is a good example. So AT&T is going to go ex-dividend on April 9th. And the dividend there is almost 28 cents, 27.75 cents. So let's just take a look at a couple things and see how this might look. So if you go out to the April expiration, just we'll look at the April regular way. Why not? It's a little bit easier. So again, ex-dividend on the 9th. Well, for an out-of-the-money call option, this isn't going to matter very much. But what if one happened to hold, for example, an in-the-money call option, like the 15.5s? So that is quite a lot in the money. Let's see, actually. There might actually be some open interest in those. Let's see what... This could be interesting, because if we find some deep open interest on any of these calls, you will very likely see a lot of call activity on those strikes just before the stock goes ex-dividend, and that's going to be, prop traders and market makers trying to take advantage of the situation. So, yeah, there's a lot of open interest right now on there's a decent amount of open interest on the April 19s, about 2,600 of those calls. There's 36,500 of the April 16s. Let's look at those. Okay, April 16 calls. Stocks trading 17.30. These have $1.30 of intrinsic value, right? So that's the difference between the current stock price, 17.30, and the strike of this call, 16. $1.30. So there is 12 cents of extrinsic premium in those options. All right, so what's going to happen at expiration? Well, and that's, by the way, to the midpoint. So is that extrinsic value real? And my take on this is it is not. How can I tell that? So we're just going to bring up a different pane here for a second. And I'm going to look in this one. This is just going to be for a little side-by-side comparison. I'm going to look at the 16 strike put. All right, we'll just delete this one. So this put is worth about 8 or 9 cents. So what do we care about here? Well, if the stock is right here, if that put is worth 8 cents now, well before the ex-dividend date, which is the 9th, what is that put going to be worth on the 9th with the stock right here? Well, it's going to have decayed a little bit. Certainly not going to be worth more money unless some wild volatility creating event has somehow crept into the horizon. So what do we care about? The dividend is almost 28 cents. The value of the April 16 put is 8 cents. So what we know for sure based on that, 28 cents is the dividend, 8 cents is the value of the put. That call is an early exercise candidate for sure. If all we did was advance to April 8th, the day before this stock goes ex-dividend, you want to either sell your call option, or if for whatever reason you want to, you could exercise your call option early. This is not a complication for most retail investors that I encourage, because you need to make sure that you know how to advise your broker that you want to exercise these options. But you want to close this out before then. Why is that? Because if you held the stock the very next day, you're going to be entitled to a 28 cent dividend, and all else equal, the stock is going to fall by a like amount, right? So that's 28 cents versus 17.30. So you're going to see a decline of 1.62% in the stock price. The call isn't entitled to the dividend, but it will decrease in value by that amount. And that's the reason why you would exercise it to capture the dividend. And in fact, what most of the traders are doing is they are exercising. So basically, they get long and short the option. They exercise all the ones they hold. And they can be up and down, by the way. Professional traders can be up and down. So I could be both long and short the exact same option at the same time. I used to do these types of dividend trades all the time in names like Philip Morris. Any stock that trades has a big dividend. Traders that don't have effectively any transaction costs, and as an exchange member, we didn't really. So if you're on the Philadelphia Stock Exchange, for example, most firms cap out their fees after a certain amount. So every incremental transaction essentially comes at no cost. So you get long and short the option, you exercise all your longs, and then you hope that somebody who is long some of these 36,000 open interest or whatever it is, they forget to exercise or they don't close them out. And basically every single time you exercise your call on the long side, but you don't get assigned on the short side, that dividend is yours to keep. So if you imagine that, let's assume that none of those are in the hands of dumb money. 36,000 contracts are in the hands of dumb money. They don't know that they're supposed to exercise or close. So they do nothing. They're just riding those calls. If you see 100,000 April 16 calls trade on April 8th, how much money do you think the market makers doing those trades are going to make? Well, you know they're not going to screw up. They are going to exercise all 100,000 of the calls that they buy. And now we're assuming that the 36,000 of open interest was dumb money, so none of that is going to be assigned. So what you can then figure out is, well, in total, that's 136,000 contracts, 36,000 of which are not going to get done. So you're going to get away with. The market makers will say, how did you get away with? I got away with 26%. So that means those trades are going to be worth about 26% of the dividend, which is then going to be about 7.35 cents. That's $7.35 a contract, because each one's 100. So that's 735 times 100,000. So that's going to be $735,000 in that scenario that I just played out, that the dealers are going to expect to capitalize on those calls. Of course, I'm going to assume that a lot of that open interest is not dumb money, and we'll do something about it. But this is an important point for everybody watching. Don't be the dumb money. If you are in deep call options and stocks that pay big dividends, you have to pay very close attention to the ex-dividend date, because if you wake up on a day on April 9th and you say, oh, I just got assigned, that's bad news. That means you missed something. And what you missed out on was that had you sold your call a day earlier and the stock essentially is otherwise just dead sideways, you would have made an extra 1.6% of the current stock price, but meaningfully with respect to those calls. So these calls are whatever, I just said, $1, they're going to be $1.30. Essentially, you're going to lose, at that point, 28 cents of the whole $1.30 that they are in the money. That's not a good outcome. So definitely pay attention to that. Okay, so let's see what else we got here. We talked about the call spread. We talked about Google close. Okay, so Google closed 147.68 today. Did I say something else? If I did, I don't know what I was looking at. But, okay. So, with T+1 starting May 28th for stocks, how does that affect options? Well, options are T+1 as it is. So it doesn't really. And you know, the funny thing is, the settlement issue, I kind of feel like this is a little bit overblown. I know that a lot of people think that, you know, with everything that's going on electronically, that, you know, why does it take 3 days to settle a trade? You know, part of that is, do we really care? Has not been, you know, On the institutional side, you could always ask when you did a trade if you needed an accelerated settlement for some reason. I don't know that I've ever taken advantage of that, though. I'm trying to think. I don't think I have. I don't know. I mean, I don't really, frankly, T+1 never, it doesn't really bother me that much one way or the other. I didn't think we needed to ramp up the settlement date for stocks that much. And options always settled T+1. You actually have to reconcile your breaks at 8:15 Central Time. For those that don't know what I'm referring to, if you've got trades coming in to you that you don't know, or you have trades going out that get DK'd, they have to be resolved by 8:15. So anybody who's been trading options for at least the last, the entire time I've been trading them, which goes back to the mid-late 90s, we've always had to resolve our settlements on the options side T+1. So I don't think that really makes much of a difference here. Doesn't underlying drop by dividend amount the day before? I am assuming you're referring to the day before the ex-dividend date. No. The stock will drop by the amount, all else equal, of the dividend on the ex-dividend date. If it dropped the day before the ex-dividend date, which by definition is a date when it's still trading with the dividend, then you would buy it, collect the dividend, and that would be an ARB. So no, it drops on the ex-dividend date because that is the first day that it trades, excluding the dividend. Okay. Would this apply to Dow transportation theory? Markets to move lower. Interesting. Yeah, so this is a broader sort of market question. As go the transports, right? So it's an important point. The theory is that the transports can give us some guidance with respect to how things are going generally, because as you would expect, there is a relationship between what is being shipped and what is being bought and sold, right? Makes sense. If we see less freight being shipped around, then presumably there's less being bought and sold. So there is, I think there's some validity to this. I think it's actually one of the reasons why people often look at things like freight rates. If freight rates are increasing for reasons that are unrelated to an input cost, so fuel surcharges and things like that. But if you're just seeing that freight rates are increasing, that just suggests that there's greater demand to ship goods. Greater demand to ship goods suggests that there is greater demand, period. So that is good. And that is shipping of all types. If you are a producer of a finished good and you are demanding more commodity inputs, so if you have raw good demand, shipping demand going up, you have finished good shipping demand going up. If people look at dry rates, Baltic, containers, all that kind of stuff, yes, I think there is a relationship. And I think that it is interesting that we have all of this chatter about, we achieved a soft landing, no landing. I'm sure some people have heard this. The Fed did it. What a miracle. And the thing that, of course, does throw a little bit of cold water on that is that we do see things like this. We do see areas where there's evidence that the economy is not necessarily ripping and rolling. Okay, so do we... this is an interesting one. With $30,000 of investable money, would you buy Apple stock outright or sell an at-the-money put and see if it gets assigned? Okay. Well, let's just take a look at Apple. So, actually, I don't know that Apple's the best example of what I was thinking of illustrating here. So $30,000 to spend, assuming you're doing so unlevered. You can buy, so the stocks closed 173.72, assuming no leverage, you'd buy about 170 shares, right? Which, as it happens, is not divisible by 100. Why does that matter? Because every options contract represents 100 shares. So if you sell one put, you are, let's just find it, again, I have a bad habit of doing this. So somebody just keep reminding me, get in my ear, tell me you got to be more, show people, don't just talk. This is my bad habit. Sorry about that. So why don't we just take a look and say, okay, well, what if you sold an out-of-the-money put, like the April 12th weekly 170 put, and we sell that thing. That looks like this. Okay. So in this trade, you sell one, you're going to collect $205 in premium. As long as the stock stays above the strike of the put you sold, 170, you're going to keep that $200. If it drops through the 170 strike, you're going to put the stock at 170, but your effective ownership price is going to be 168-ish, a little bit less, right? 167.95. Why? Because you're paying 170 for the stock, but you collected $2.05 a share to do that trade. And interestingly, you can be assured of getting put the stock if you wish by adjusting that strike. So I could just bump that strike up and say, okay, well, what if I sold an in-the-money put then? Now I'm going to sell the 175s. Those are $1.28 in the money. I collect $4.13. So again, I'm going to be collecting more than $2 next. In fact, I'm getting more extrinsic premium from doing this trade. They're $4.13. They are $1.28 in the money, $4.13 less $1.28. So I'm getting more than the $2.05 a share I was collecting. And now I have more upside participation, and I'm going to still buy the stock at $175, but I'm going to, my effective purchase price is going to be less than $171 because of the $4.13 in premium I collected. So that's a $2 and change discount, $2.50 discount to where the stock's currently trading. So all good. But I can't do this to be full up on a $30,000 position because it's 100 shares per contract. So what could you do? Well, one of the things you could do is you could say, well, how about a little of both? You could sell one cash covered put and you could buy some stock. And that's kind of a hybrid, right? So we're just going to, you buy 70 shares-ish. We're just, it's not exact, I know that, but it just gives us a sense. And you end up with a payout profile that looks a little bit like this. So you're getting a standstill rate of return. You get participation in the stock, and you get something like this. And I think it's important to bear in mind that it's totally fine to combine stock and options trades in this way, if you're inclined. Another point I would make, which is that it's maybe not, this is not the best example of it, but there are circumstances where, the premiums and the options are so great that you can actually sell a downside put that's well out of the money and risk effectively the same amount of money that you would have had you bought the stock at spot by selling more downside puts. Not easy when you have an amount of capital that is, not many multiples of whatever the contract size is, but it's an important point. And another important point, too, is that there are going to be positions, stocks, where, depending on how much capital you have to work with, high dollar stocks like NVIDIA would be an example, Broadcom would be an example, Booking, formerly known as Priceline, would be an example where if your total capital amount is significantly less than the share price times 100, that something like a naked put sale or a naked call sale is simply just not going to be tenable. And I want to make this point too, which is you can get the price down of an options trade down to something where it is potentially digestible, But understand that the risk-reward characteristics of a trade like that can be very, very different. So let me give an example and just say, okay, well, let's say I traded this NVIDIA call spread. So I could choose something that's actually very close to at the money, or even slightly in the money. Stock's 884. So let's just say I looked at the 880, 1,000 maybe. No, it doesn't even, actually, I'm going to make it really tight because I think this will help illustrate the point better. 880, 890 call spread. Okay. Well, look at the price of this, $448, $4.48 a share. And if I had, say, 10,000 bucks in my account to deploy to a trade like this, am I able to use a trade like this as a substitute for buying $10,000 worth of stock, which is just going to be a handful of shares, right? And the answer is no, because the risk-reward characteristics of this trade, even though I'm spending the same amount of money, is very, very different. If I buy $10,000 worth of NVIDIA and the stock falls 5%, I'm going to lose $500. If I spent $10,000 to buy some number of call spreads like this and the stock falls 5%, well, 5% of the current stock price is going to take it way out of the money, way below 880. And I'm going to lose all of it. So it's important to understand that when you think about the risk-reward characteristics of trading options on the underlying stock, it is true that you can only lose the premium you spent. And if you buy a stock, you can only lose the amount that you spent on it, assuming you're not using leverage. But that does not mean that if I put $10,000 in premium on an options trade, that the risk is comparable to putting $10,000 into the stock. The way I always like to look at things, actually, I don't know that I've ever mentioned this before. So the way I always look at it is I say, what's the P&L that I'm willing to take on a delta 1 position? The delta 1 is just if I took on the stock. So let's just say, for the sake of argument, that I want $100,000 worth of stock, which means that if the stock drops 10%, I lose $10,000. If it goes down 20%, I lose $20,000. If it goes down 1%, I lose $1,000. Well, I always compare that to the corresponding options trade I'm using to make a directional bet and try to size it in some comparable way. And use the fact that I'm managing risk with options simply to be able to deploy that capital to more trades, not just to be able to pile more leverage into a trade, if that makes sense. Okay, so where are we? Oh my goodness. How do I chew up the clock so much? It's ridiculous. You guys, thank you very, very much for watching. So just a couple quick important points. I didn't know this before, but so there is an affiliate link below for OptionPlay for those of you who are interested and don't happen to have it. But I believe I was advised that those that use that link get a discount. Can somebody tell me, producer Jay, how much is that discount? Do we know? Really? Don't hold me to this. I think I just heard it was 40%. So 40% off of the prevailing price for those who elect to sign up and use OptionPlay, which is the thing I've been using to illustrate this on here. So please be sure to like, subscribe, do all the regular stuff that you would. Maybe you give OptionPlay a trial if you haven't done it. And I'm going to be back here same time at 4:15 on Wednesday. And I look forward to seeing you then.